Hello and welcome to Dukascopy TV. Today we're focusing on the UK and in particular oil and the pound. Joining me on the line is Brian Hilliard, Chief UK Economist at Societe Generale in London. Brian, thanks for joining me today. Now there is talk amongst analysts that UK trade data is being affected by a reduction in oil exports. Is this true, and what sort of effect is it having?
Well, yes, it's a straightforward fact. We've had a big reduction in the fourth quarter compared to the third quarter. There are two issues playing out. One is that there was disruption because of maintenance problems in the North Sea, and we've seen a bounce back up in the later data, September and October, where we saw these big falls in output, and that led to a big fall in exports, but that bounced in November, probably in December as well. So that's a sort of short-term volatility, but there is behind that a longer-term downtrend. The North Sea fields in the UK part are increasingly mature, and the output levels are falling steadily.
Okay, how's all this going to play out in the currency market then? I mean, will we see a continued erosion of the pound, or are you expecting a shift for sterling?
It could to some extent. There's also the other things going on. I think that we've seen some disappointment on growth, which ties in a little bit with oil and gas, but also some concerns about our safe haven status. Are we letting the debt mandate slip a little bit in the sort of fiscal mandate the Chancellor has set? All these things sort of chip away at the value of the currency. But then we're also caught in the crossfire between the dollar and the euro. Whenever the euro rallies strongly as a dollar, we typically underperform the euro quite significantly.
There's speculation this week we'll see solid gains in UK retail data. Do you agree? And if so, what is likely to be the main cause of these possible gains?
Yeah, I think that we should see an increase of a little over 0.5% on the month. It's going to be the usual story of deep discounting. Some areas are doing better than others. Internet sales still strong, but a little bit weaker than in the sort of boom time just before Christmas. Clothing and footwear did particularly badly, so we shouldn't be expecting much from that, and that's going to be reflected in the price data that is published in line with that as well. But I think the basic point I'd take from this data, if it's confirmed, is that the snow didn't do much damage, and that's quite heartening because people tend to describe the UK consumers fundamentally very weak. I think, in fact, the consumer's been very resilient.
Just before we finish, what are your final thoughts on the UK economy as a whole and on sterling looking ahead?
The UK is actually growing a little bit in underlying terms. We've had a year of deep distortions, snow, loss of a working day because of the Diamond Jubilee, recovery because of the Olympics, then a fallback in Q4. I mean, if you strip all that out, I think there is positive growth in the economy already, and the evidence I would cite to back that up would be the state of the labour market. It seems very difficult to explain how hours work can be growing in the economy substantially and steadily whilst output in the economy is falling. That just doesn't gel at all. So I think there is underlying growth. I think it's going to be sub 1% this year, but it certainly will be a positive number. The question really is it strong enough to actually satisfy the Bank of England? The answer is probably not. Their forecast for this year currently is 1.2%, but that will be updated in the inflation report on Wednesday. I think that still gives a bias to easing. I don't think that can be expressed through interest rates, but they will stay anchored at very low levels, and that does tend to bring some weakness to the currency.
Well, that's all we've got time for today. I'll be back tomorrow with the press review. Don't forget to check out the week ahead with Navjeet for a list of the key events to look out for this week. But for now, goodbye.